morning. Let's get going. Our next session on global equity, and here to moderate the session is Brendan de Jong from Portfolio Metrics. Brendan, thank you so much for joining us here today. It's really great to have you here. Joining him as well on the front is Andreas van der Horst from Mazi Asset Management, Adrian Clayton from North Star Asset Management, and all the way from London, Ben van Leeuwen from Lindsell Train. Gentlemen, thank you very much for being here with us today. Looking forward to your session on global equity. Andreas, if you're ready, you can actually start presenting and we can get going from there. Thank you.
Eugene, thank you very much for the introduction. Ladies and gentlemen, it's great to be here today. Let's get right into it. Performance is what matters. The Mazi team has delivered in chunks a meaningful performance after fees that you can have confidence in. We are enormously proud of our 1 and 2 year figures. We have delivered alpha of 7.1% over 1 year and 9.1% on a 2 year CAGR basis. On a 3 year basis, we are inching ahead. We've got confidence in our proven quality investment philosophy and process to outperform over the long term. Our fund is entirely invested offshore. Dollars paint the real picture of what's happening out there. The last 2 columns on the table present the dollar figures. Ultimately, we want to deliver real above benchmark hard currency returns to you. To sum up, we've delivered compelling global equity performance at a very attractive fee of 80 bips all in. How did we deliver this performance? Our performance is built on the foundation of our quality investment philosophy and repeatable process. We take 3 steps. We go out and search for the best companies in the world. To be clear, not fair companies at wonderful prices or speculating on tomorrow's next big thing. We're looking for companies that have already won and continue to win. Next, we buy these businesses at the right price. Valuation matters tremendously for generating exceptional long-term investment returns. And lastly, we let them compound. We are patient. Our portfolio turnover is very low, less than 10% a year. To quote the late Charlie Munger, the big money is not in the buying and selling, but in the waiting. Buy the best companies, buy them at the right price, let them compound. It's that simple, it's that hard. Let me explain why we follow this investment philosophy. We want to balance 2 central elements: deliver in hard currency and above benchmark performance over the medium to long term, and manage risk by avoiding the permanent loss of capital. So, what do we see as quality? If I can capture it in one concept, it's return on invested capital, or ROIC for short. Simply put, return on invested capital is the after-tax operating profit earned by a business against the amount of capital used to generate that profit. The question we are trying to answer is, how hard does the capital work in the business? How much after profit tax does each dollar of capital produce? The higher the number, the better. Why is this useful? ROIC is the one number that sums the total of all capital allocation decisions in the life of a business. You see, to us, this number provides a view into the heart and soul of the financial algorithm underlying the business. It is, in our view, the ultimate measure of intrinsic profitability. But ROIC is meaningless without context, which is why we compare it to the cost of that capital, or WACC, as they say. We look for businesses where there is a big positive gap between the ROIC and the WACC. That gap is the excess profit. The textbook name is economic value add, EVA. We want companies that produce lots of excess profits persistently. Plenty of companies do the opposite. They destroy shareholder capital. We want to avoid them. Next, we want a margin of safety. To us, this means competitive moats, high barriers to entry, ungeared bulletproof balance sheets, structural profitability through the income statement, and of course, we want to buy these businesses at an attractive valuation. But intrinsic profitability is not enough if you want to grow wealth in real terms above benchmark in dollars. You need secular growth, but not just any type of growth. You need the type of long-term growth that comes from the ongoing reinvestment of today's profits at higher returns on invested capital. It is this type of growth that over time multiplies the free cash flow attributable to shareholders. It is no surprise then that growing free cash flow drives the underlying compounding value of the business over time, leading to multi-bagger investor outcomes for the patient long-term investor. Lastly, we want to deal with honest, ethical, shareholder-focused people. Management holds the line between shareholder wealth creation and shareholder wealth destruction. Better to work with people that you can trust. Let me give you a picture of what I'm talking about when we speak of return on invested capital, weighted average cost of capital, and economic value add. Here's a picture of the index since 1995. If we look at the markets or global markets through the lens of return on invested capital, we can see that the median company earns a ROIC today of about 8.6%. This is the green line in the chart. This is what the companies earn on the capital in their businesses. The WACC is 9.1% today. That is the red line on the chart. This is what the capital costs. In good years, there's a positive gap. The companies are producing excess profit. Look at the gray bars. In bad years, our benchmark company destroys shareholder value. If you plot a cumulative figure for these excess profits over time, you will see the purple shaded area. Our benchmark company has delivered, give or take over 29 years, no more than 1.3% over the cost of its capital. Now, we've all been in the markets for some time. And if you consider the risk that you take in equities and the volatility that you have to stomach on a daily basis, earning an underlying 1.3% over time is a paltry result, you would agree. It's nothing to get excited about. So, what do we want to do? We want to own businesses that are substantially better than average. This is an example of a high ROIC business. This is the same picture, but for Meta Labs. Meta owns Facebook, WhatsApp, Instagram. It seems investors either hate or love this business. I can't count the number of discussions that I've been involved with where smart people have told me Facebook is going to zero. First, it was the Cambridge Analytica scandal. Then they were spending too much on the metaverse. Then online advertising apparently went ex-growth. Now they're spending too much on AI. But, as Warren Buffett said at this last weekend's Berkshire AGM, the market is there to serve you, not instruct you. The fiction cannot be further from the truth. This company is an excess profit machine. It has more than 3 billion users that it monetizes every single day. It has a track record of successful, profitable execution and growth. We've owned this business since day one. In the last year alone, the share is up 80%. The best years are still to come. This company is the undisputed king of capital allocation. It's an excess profit and share buyback machine. It's one of our largest holdings due to investment return, not position sizing. The company is called AutoZone. It offers repair services and sells aftermarket car parts. It follows the same formula in, day out. In the last 10 years, AutoZone has almost halved its share count. Over the same period, earnings and free cash per share are up 4 times. That's compounding free cash per share at 15% per annum in dollars. A very traditional company delivering exceptional investor returns. It's also useful to talk about businesses we don't want to own. It helps to focus the mind and ensure that we don't spend our time on businesses that are not good for us as shareholders. Let's talk anti-quality. We South Africans have a thing for mining. It's in our blood. But when the history of investment is written, mining will be the poster child of investor misery. For most time, resource companies have earned less on the capital invested in their businesses than the cost of that capital. Clearly, core business here is pouring money into a hole. I think the correct mining term is slope failure. As you can see from the picture, Glencore is a classic example of a business that is not good for shareholders. They are serial capital destroyers. When you put all the elements of our investment philosophy and repeatable process together, where do you end? The table on the left presents a scatter plot of the MSCSI ACWI. The vertical axis shows the median 5-year average revenue growth rate for the ACWI, which is about 10%, and the horizontal axis, the median return on invested capital over the last year, which is about 9%. Our portfolio is on the right. Our businesses have grown 50% faster, and they're almost 3 times as profitable. The underlying profitable compounding of our portfolio is simply better than the market. To finish off, we believe our quality approach will provide long-term investors with above benchmark performance in hard currency at much lower risk. Thank you.